Subscribe to my channel Report Stock.
Welcome to the Deep Dive. We're the show that tries to cut through the noise, looking at the reports, the shifts in industry, and giving you some clarity. The business world, it's always changing. Companies adapt, they evolve. But sometimes, wow, a company makes a pivot that's just dramatic. Really makes you wonder, how do you figure out what's really going on when a company basically reboots itself? Especially into a booming field like AI. So today, we're doing a deep dive into Jet.ai, specifically their recent Q2 2025 financial results. And this isn't just, reading numbers. It's about understanding a company that's right in the middle of a huge transformation. Our mission here is to sort of unpack these financials, the operational updates, and really see the story. The story of Jet.ai shifting from aviation at its roots to becoming purely an AI data center company. We'll look at how this massive pivot shows up in the numbers and, well, what it might mean for where they're headed. And just so you know, we're drawing this straight from their official press release, the Jet.ai 2025 second quarter financial results. Got the balance sheets, statements of operations, cash flows, the works. For you listening, this should be a really useful kind of real-world example. How to analyze a company going through a massive change using its own data. What metrics actually matter in a situation like this? Okay, so let's dig into this. Jet.ai. They kicked off in 2018 out in Las Vegas. Initially, they had two main parts to the business, right? Software, their app, and aviation. That covered charter flights, jet cards, managing planes for people.
Yeah, pretty distinct segments.
But the big headline now is this transition. They're aiming to be a pure play AI data center company. And that's not just, adding a service. It's a fundamental shift. Their entire focus moving to building that specialized, power-hungry infrastructure that AI needs.
Right. Forget the planes and pilots, basically.
Exactly. Think servers, massive cooling systems, complex power grids. It's like changing their whole operational DNA.
It's a huge strategic bet, really.
Yeah.
And it says a lot about where the tech demand is right now. Why AI data centers? Well, the company's pretty clear. They want to, quote, build a scalable, high-performance infrastructure to support the increasing computational demands of artificial intelligence.
Okay.
So it's not just jumping on a bandwagon. It feels like a strategic move targeting what could be the next big bottleneck for AI growth. I mean, you see chip makers like NVIDIA selling everything they can make.
Yeah.
The next piece is, where do you put all those chips? How do you power them?
Right, the actual physical infrastructure.
Precisely. Jet.ai seems to be aiming to be the landlord for all that computation. Now, that means huge costs up front, obviously, massive capital. But the flip side is potentially significant long-term recurring revenue if they execute well.
So a totally different business model compared to aviation.
Completely different. From a service-based kind of fragmented industry to something much more capital-intensive, infrastructure as a service.
And it looks like they're already making moves, not just talking. The press release mentions some concrete steps backing this up. First, there's a capital contribution to something called AIIA Sponsor Ltd.
Oh, yes, the spec sponsor.
Right. So this AIIA sponsors AI Infrastructure Acquisition Corp., which is a SPAC, a special purpose acquisition company. And its goal is apparently to buy private companies, strategic assets, in AI, machine learning data centers.
Standard SPAC playbook, basically.
Yeah. And through this contribution, Jet.ai gets an equity interest. They say it's to boost their book equity and sort of solidify their position in this new AI data center world.
What's interesting there is they're not just saying they'll enter the market. They're putting money down, forming partnerships pretty quickly. And beyond that SPAC thing, they also signed a definitive agreement, a joint venture, with a company called Consensus Core Technologies, Inc.
Okay, what's the plan there?
The plan is to develop 2 hyperscale data center campuses, one in Midwestern Canada, another in Maritime Canada.
Hyperscale, that sounds big.
Oh, it is. We're not talking about just adding more servers to a room. These are enormous modular facilities designed for crazy scalability, high efficiency. They need to support, potentially tens of thousands of servers. And the power draw for AI workloads is just immense, building these, incredibly expensive and complex.
Wow.
And the company's executive chairman, Mike Winston, he actually mentioned 5 strategic milestones for these Canadian projects. And he specifically said they're, quote, approaching the announcement of 2 upcoming milestones. One is about power for the Midwestern site. The other is about progress at the Maritime site.
So tangible steps, things we can actually track.
Exactly. It shows real, measurable movement in this new direction, not just talk.
Okay, so what's really interesting now is how all this forward-looking stuff, this big pivot, actually shows up in their current financials. especially as they're winding down the aviation side. You can almost like feel the gears grinding in these numbers.
Yeah, the transition period financials are always fascinating.
So overall revenue for Q2 2025 was $2.2 million. That's down from $3.1 million the same time last year.
A noticeable drop.
And they explain it pretty directly. They say it's, quote, primarily due to a reduction in Cirrus Charter and Jet Card revenue, which stemmed mainly from clients, prospects, and vendors anticipating the sale of the company's aviation business to Fly Exclusive.
Okay. So the market knows the sale is coming.
Seems like it. And they also mention, as well as reduced flying by our management clients.
And if you dig into the specifics, the aviation revenues really took a hit across the board. Like their software app and Cirrus Charter revenue, down about 19%. And the management and other services revenue that's from managing other people's planes, that dropped nearly 42%.
Wow, that's significant.
It really is. It's not just a little dip. It looks like a deliberate scaling back.
Yeah.
Which is exactly what you'd expect if you're planning to sell off that whole part of the business.
Right. It's strategic, not necessarily a sign the aviation business itself was failing catastrophically, maybe?
Well, it could be a bit of both, but the anticipation of the sale is clearly a major factor they cited. It signals they're executing the exit plan.
That makes sense. But, they did mention that reduced flying by our management clients bit too. So how much is them actively scaling back versus maybe just some natural decline in that segment anyway? Does that really matter in the grand scheme?
It's a fair question. It's probably a mix.
Yep.
But ultimately, whether clients left because they anticipated the sale or flew less for other reasons, it all points towards the exit. The key thing is it fits the narrative of divesting aviation.
Okay. And speaking of that divestment, the sale to Fly Exclusive that's still on track.
Yep, the release says it remains on track to close by October 31st, 2025.
Got it. And the trends for the first 6 months of 2025 look pretty similar.
Yeah, basically the same story. Overall revenue down to $5.7 million from $6.9 million a year before. Similar declines in the aviation categories. Consistent wind down.
So moving beyond just the top line revenue, how is this huge shift impacting their overall financial picture? Costs, profitability, that sort of thing.
Right. Putting it all together, it's quite revealing, actually. Even though revenues went down, their gross loss actually improved.
Improved? How does that work?
Well, for Q2, the gross loss shrank to about $110,000. Last year was over $400,000.
Wow, yeah, that's quite a difference.
And for the full 6 months, the loss also got smaller, about $226,000 compared to over $500,000 last year. The reason? They stated it was largely driven by the scale back in operations during the quarter.
So cutting costs faster than revenue fell in that segment.
Seems like it. For the 6-month period, they specifically mentioned lower maintenance costs, lower pilot wages, and also just using their own Honda Jet Elites less.
Makes sense. If you're selling the planes, you stop spending so much on them.
Exactly. It shows they're managing the costs down effectively in the business they're exiting, which is pretty crucial for a smooth divestiture.
And was it just the cost of goods sold? Or did other expenses go down too?
Other expenses too. Operating expenses dropped in both Q2 and the 6-month period.
How much?
Q2 was $2.4 million, down from $2.8 million. 6 months was $5.4 million, down from $5.8 million. They said it was mainly lower G&A general and administrative and lower sales and marketing costs.
Okay, tightening the belt all around on the old business.
Pretty much.
Yeah.
And that led to a much better operating loss figure too. Q2 loss was $2.5 million, improved from $3.2 million. 6-month loss was $5.7 million, better than the $6.4 million loss last year. So definitely moving in the right direction operationally, even with lower revenue because they're shedding the aviation costs.
Okay, now this next part. This genuinely made me pause when I looked at the financials. Despite these operating losses, JTAI's cash position actually went up significantly. They had under $6 million in cash at the end of 2024, right?
Yeah, about $5.87 million.
And by June 30, 2025, they had roughly $8.3 million. So how does that happen? How do you lose money operationally but end up with more cash? Are they just loading up on debt or something?
That's a great catch.
Yeah.
And it really shows why you absolutely need to look at the cash flow statement, not just the income statement.
Okay, so what does the cash flow statement tell us?
It reveals the key. Under financing activities, there's a line item. Proceeds from exercise of Series B convertible preferred stock warrants.
Warrants. Right, like options to buy stock.
Sort of, yeah.
Yeah.
Think of a warrant as like a voucher giving an investor the right to buy shares later at a set price. When they exercise those warrants, they pay the company that price to get the shares.
And that means cash comes into the company.
Exactly. And in this case, it was a big chunk of cash. $11 million came in during the first 6 months of 2025 from these warrant exercises.
11 million. Okay, that explains the jump in the cash balance.
It does. It's not debt. It's equity financing, essentially. A really crucial way for them to get the capital they need to fund this incredibly expensive pivot into data centers.
So that cash injection is basically the fuel for this whole transformation.
Absolutely. It's the lifeblood enabling this aggressive strategic shift. Without that financing, this pivot would be much, much harder, if not impossible.
Right. So we're seeing a company actively, tearing down its old identity in aviation and going all in on AI. What are the key things we should be watching for next, the critical events that will really show if this gamble's paying off?
Okay, a few really important things to keep an eye on. First, obviously, is the closing of that fly-exclusive deal, scheduled for October 31st, 2025. That seals the exit from aviation. Makes them truly a pure-play AI data center company, on paper at least.
Right, the final break.
Then you absolutely have to watch for those milestone announcements for the Canadian data center projects, especially anything about securing power for the Midwestern site and just general progress updates on both locations.
Because that shows if they're actually building things.
Exactly. Talk is cheap. Building hyperscale data centers is incredibly hard and expensive. Those milestones are proof of tangible progress.
Makes sense. Anything
Yeah.
else?
I'd also watch the long-term impact of that equity stake they got through the AIIA sponsor contribution. How does that affect their balance sheet over time? Does it give them strategic advantages in the AI data center market? And maybe the biggest underlying question, the $11 million cash infusion from warrants, is that enough to really get hyperscale going? Or is it just seed money for a much, much larger funding round they'll need later?
Good point. This is just the start of the spending.
Probably, very likely.
Okay, so this deep dive really highlights JetAI's super aggressive pivot, doesn't it? From aviation into this high-demand AI data center space. And the financials, they kind of tell both sides of the story, the challenges of shutting down the old business, but also the crucial financial moves, like those warrant exercises that are making the new direction possible.
Yeah, and for anyone interested in corporate strategy, it's a fascinating case study. A managed divestiture in action. They're not just selling assets, they seem to be actively disengaging from the old operations to really signal commitment to the new strategy.
It really underscores that you need to look past just the bottom line, doesn't it?
Absolutely. You have to see the story, the strategy woven through all the numbers and the operational updates. It's about figuring out the why behind the financials, especially when a company is undergoing such a radical change.
So as JetAI takes this huge leap into AI data centers, maybe something for you to think about is this. What are the biggest hurdles a company faces when it completely redefines itself like this, especially entering a field that's so capital intensive, so competitive like AI infrastructure? And, what might this whole situation tell us about the future? Is it better to be highly specialized or more diversified, especially when technology is changing so incredibly fast? We'll leave you mulling that over.
Subscribe to my channel Report Stock.